Hello and welcome to Market Domination. I'm Josh Lipton, live from our New York headquarters. Big tech earnings continue to roll in, but markets remain in the red today as investors digest a flurry of earnings and headline news. We're going to dig deeper into Apple and Amazon results. But right now, there's just under an hour to go until the closing bell. And stocks are lower here. The Dow's down about 20 points. The S&P 500, though, your broad gauge, it's down about 0.7%. Tech-heavy NASDAQ, it's down about 1.4% right now. Let's welcome in senior reporter Inez Ferre with the latest on today's trading action so far. Inez.
Josh, as you just mentioned, we're looking at the Dow right now that is just below the flat line. It had been slightly higher throughout the session, a little bit of a choppy session for the Dow today. So we are seeing it lower. And also the NASDAQ, which yesterday had still clinched a record today, it's down 1.4%. We'll get into those tech-heavy names that are dragging on the NASDAQ composite, but nevertheless, it is off its highs. And then also the S&P 500, which yesterday had ended flat, today down 0.7%. I do want to mention the Russell 2000, the small caps, those are slightly lower as well right now. And I also want to just take a look at where we're at with the 10-year Treasury, because we had seen that after the Fed had lowered rates yesterday, we saw that the longer yields were on the longer end of the curve. Those had actually gone up a bit. So we are seeing today a little bit of a move higher on the 10-year Treasury yield. We're seeing it at 4.09%. The 30-year also ticking a bit higher, as well as the U.S. dollar index that is going higher as well. And that may also be impacting equities or the broader markets as well. Looking at Bitcoin, we are seeing Bitcoin rolling over, down more than 3.5% at around 107,000 per token. Let's take a look under the hood where we're at with equities, because we did mention that the NASDAQ was down the most. And if you take a look at the NASDAQ 100, you will see a mixed picture for the Mag 7. So you're looking at NVIDIA that's below its $5 trillion valuation. NVIDIA is down more than 2%. We're also taking a look at Microsoft, down more than 3%, despite its strong report yesterday. We did see Microsoft getting hit after that report, and also Meta down 11% for the session, as investors may be a bit concerned with the amount of AI spending that Meta has been on course with. Also, Alphabet, that is higher. So Alphabet also spending quite a bit on AI, but you're really seeing the return on investments, or at least the street is more enthused about what they see with the results so far and those AI investments with Alphabet. And if we just take a look at a year-to-date chart with Alphabet, you're looking at year-to-date, it's up nearly 50%. Also looking at the chip space, those are also lower as well. So we have seen, as I just mentioned, NVIDIA. Well, you're looking at Broadcom, that's also down as well. AMD is also lower. I had mentioned the crypto space a little bit. I mentioned Bitcoin, but we are also seeing the rest of the crypto space that is under pressure. Ether is down more than 5% at 3,700 per token. If we just take a look at a year-to-date chart, you're still looking at Ether that's up 11% year-to-date. But nonetheless, for those crypto bulls that were expecting a better month for October, we are seeing that crypto in general appears to be rolling over, at least over the last couple of sessions here. Josh?
All right, thank you, Inez. Well, after a mixed set of results from some of the Magnificent Seven names, and Amazon and Apple are gearing up to report after today's market close, and Yahoo Finance's Dan Howley joins us here with what to watch out for. Dan.
That's right, Josh. We're looking at both Apple and Amazon this afternoon. We had Microsoft, Meta, and Google yesterday. And I just want to go to bed. The big thing for Apple is obviously going to be iPhone sales. There was this Counterpoint Research report that said that in the first 10 days of sales of the iPhone 17, they were up 14% year over year in the US and China versus the iPhone 16. That could mean good things for Apple in this quarter, because just, while the 17 was on sale, as in every year, we only get a small amount of those sales in Q4. The bulk of it's in Q1, so we'll have to wait to see how the sales are performing more generally for next quarter. But in this quarter, we're expecting iPhone sales of $49.3 billion. That would be up 6.7% year over year. The services segment is supposed to see $28.2 billion in revenue. That would be up 12% year on year. And EPS is expected to come in at $1.77 with revenue of $102.1 billion. So, this is obviously a big time for Apple. They just crossed that $4 trillion market cap. They're holding on to it. That puts them in the same league as Microsoft, which previously crossed it, but has since fallen back, and NVIDIA, which crossed it and then said, I don't want to hang out here. Let's just go up to $5 trillion. So yeah, I think obviously the big deal here is going to be iPhone sales. You can expect people to ask about what's going on with their AI strategy, but you're probably not going to get much from Tim Cook.
No. On Amazon, let me ask you this. Everybody's going to make a beeline for that AWS number, right? The cloud computing business. What's your take on just the state of the cloud computing wars? Because you got Google, we heard from Microsoft. Azure was up, what was it, 39%? Yeah. Why is Amazon AWS not growing at that same rate? Is it just the law of large numbers, Dan? Is there something else going on? What do you see?
There's a lot of agita when it comes to AWS, if I can be very East Coast and use agita. There's the thought that, look, sure, they have Bedrock where they offer a bunch of different AI services, but they don't have a marquee like OpenAI. Google has Gemini. AWS, they have Anthropic, but oh yeah, it splits time with Google as well. So I think that's the big concern there. They did announce that Anthropic's going to be using 1 million AWS chips to train and deploy. That comes a week after Google said literally the same thing. So it doesn't really give them much of a boost. But for the quarter, we're looking at AWS revenue of potentially $3.2 billion, up 18%. Not as high as Microsoft, law of large numbers, and I think probably part of that AI action.
All right, another busy day for Dan. Thank you, sir. Well, as we continue to watch tech earnings roll in, our next guest says it may be time for investors to look beyond the so-called safe haven of the Magnificent Seven. Plus, he also warns of circular investing taking shape across markets fueled by the AI boom. Let's welcome here Patrick Ryan, Madison Investments Chief Investment Strategist. Patrick, great to see you. So let's start there with big tech, Patrick. You had big names reporting yesterday. You got big names coming after the bell today. Big picture, what have you learned from those big tech earnings reports, Patrick? Do you feel like you have greater line of sight into that mega AI trade and trend?
Yeah, well, first, thanks for having me on, Josh. What we're learning is the earnings just keep on going. They're there. The earnings are there, but right now also the spending's also there, and I think that's what you got caught up in looking at. Who did well today versus who did not do well today. Broke down the spending, but the earnings are unequivocally there, but the spending numbers continue to be eye-popping. So I think that's where we have to be looking down the line and start to look towards, where is the revenue going to come from to make that work.
When you look at that AI trade, Patrick, as an investor, do you have concerns about what you're seeing there?
Of course you have concerns. I mean, there's parallels. Everyone wants to draw back to the late 90s and vendor financing and some of the circular nature of what we're seeing. So certainly when you start to see all of these different companies investing in each other, you're wondering, are we getting near the end? Is this a way to keep propping up this continued AI trade? So, clearly OpenAI has got a big checkbook to keep writing all these different deals. And then you have NVIDIA coming in, giving these deals. But it starts to, as an investor, put your senses up a little bit more, give you that spidey sense, and an ode to Halloween here, that maybe this is getting a little bit long in the tooth.
So if it's getting long in the tooth, Patrick, and you're looking for other opportunities outside the Mag 7, where would those be?
Yeah, as long as the economy continues to do well, you can look down cap. So, I mean, when you look at a lot of the stocks have been left behind this year. I know everyone wants to point to the S&P versus the S&P 500 equal weight. That's been a big difference here year to date, where you look at, really the overall equal weight is about half of the S&P 500 right now. Only about 35% of the stocks in the index are beating the S&P 500. So there's a lot of places you can go. Certainly if you look at an economy that might be getting better, continued great GDP growth, you look at maybe some more capital spending along with one big beautiful bill and the immediate expensing. there is more opportunity down cap, where the valuations are still, not necessarily screamingly attractive relative to history, but definitely attractive relative to the S&P 500. So if you get down into the S&P 600 or the S&P 400, much better opportunities, although the earnings right there need to pick up to make that happen, and you need the economy to start taking off a little bit more to see that come through.
I want to get your take on the consumer, Patrick, and where you think the consumer's at, how healthy, how resilient. I asked because, Chipotle reported results. The CEO made some comments there that were interesting, Patrick, and got a lot of attention, and basically talking about how the pullback in all income cohorts seen earlier this year has now widened, saying with low to middle income guests further reducing frequency. And I'm just wondering, as an investor, as you comb through those earnings reports, what's your takeaway of the consumer right now? How healthy does the consumer look?
Yeah, I mean, the Chipotle thing today is alarming because right now you've had that bifurcated economy where the high end has been doing well. The bottom end has not been doing well. The bottom end is struggling. And now you're seeing kind of that drip up into the next level. So clearly, if you look at the economy, consumer spending, that isn't alarming when you start to drift up into the next strata of consumers. Certainly, so you want to take that into account in your overall economic outlook, along with what's the employment outlook. So if you start to see inflation has been hitting these consumers harder, it's starting to flow into the next strata of consumers. That's going to be a problem if we start to see the employment start to roll over into a kind of a more of a serious nature.
We talked about big tech, Patrick. We'd also like to get your thoughts on the Fed. That was, of course, another big event this week. And you got the cut, but of course, a lot of the focus was what on Jay Powell said about the next meeting, a December cut, no sure thing. I think he actually said far from it at one point, Patrick. What'd you make of that?
Yeah, I was surprised when he said it. Obviously, I think for most of the market, it was a foregone conclusion that December was going to be a cut. Even for the Fed themselves, they have that penciled in for another cut in December. So clearly there was a message he wanted to send to the market. I believe that maybe in the Fed's eyes, it could be a couple different things. The Fed may have thought that the market has gotten too far in front of itself, or in front of them in terms of their expectations for cuts. Next year, up until more recently, there was, odds of getting down under the 3% Fed funds rate. So clearly that had been spiraling down. And you also have a pretty wide, diverse opinion on where monetary policy needs to be at the Fed. So it could have been an ode to, the rest of the FOMC members to kind of hear their voice. So you had a dissent on each side. Clearly, the FOMC wanted to send that message that, hey, it's not a foregone conclusion. We have a very, low visibility into the state of the economy, given the shutdown and all the economic data. So we just need to slow things down. But I think when you look at it, just at the repricing of December, the market's really not seeing that that it's not still a foregone conclusion. The market's still at greater than 70% odds that we will see a cut in December. So definitely a message, but I think they end up cutting still this year. And next year, you probably won't see quite as much unless we see a deterioration, unemployment spike, or some other deterioration in the consumer.
Patrick, great to have you on the show today. Thank you.
All right. Thank you, Josh.
Coming up, rally in gold prices has cooled over the last week. Is it just a pause or the start of a trend? Strategist weighs in. Stick with us. Airline CEOs went to the White House to warn about how the ongoing shutdown could impact air travel. Yahoo Finance senior reporter Praz Subramanian is here with more. Praz.
Yeah, hey, Josh. The event just ended about 20 minutes ago. It was hosted by J.D. Vance, VP there. Had a number of CEOs, including the United CEO, American CEO, a couple of the union heads from the government employees, talking about how this shutdown was sort of hurting not only the American people, but also the workers. So United CEO Scott Kirby said, quote, "It's putting stress on people. It's not fair to those people," meaning the air traffic controllers. It's also putting stress on the economy. It's been 30 days. I also think it is time to pass a clean CR. Now, Kirby also noted that only 2% of flights have been delayed during this strike, so that's not nothing crazy, but potential for more there. So Secretary Duffy adding that a lot of our air traffic controller workers can go through and miss one paycheck, and it's hard for them. But then he said none of them can go through two paychecks, right? So basically, what you're seeing is you're trying to see a pressure applied to the Democrats for a clean resolution. Now, for their part, Democratic leadership views this as leverage for them, right, to secure subsidies for healthcare for millions of Americans. So that's sort of the battle there. Interestingly, we spoke to Delta CEO Ed Bastian earlier in October. He said, quote, if this thing continues, I'd say beyond next week, it's going to probably be a bigger source of concern for all of us. That was 3 weeks ago. So you can see why there's a lot of pressure here on the airline CEOs, also the workers, to try to get a deal done here because, in a few weeks, we're going to have Thanksgiving holiday travel. That's going to be a potential disaster time if we have a lot of people out on work.
All right, Praz, thank you. Well, the gold rally taking a breather here following the Fed's 25-point cut on Wednesday, but Fed Chair Jerome Powell signaling no December move in his post-decision press conference, pushing yields higher and weighing on gold prices. For more, I want to bring in now Ben McMillian, Chief Investment Officer at IDX Advisors. Ben, always great to see you, especially on set. So let's talk about gold. This red-hot trade cools. First of all, why did it cool? Is that? Do you see it, Ben, like that's technical, that's macro-driven, that's both? What do you see?
Yeah, it's really technical driven, and I think it's helpful to kind of zoom out and look at what contributed to this, huge rise in gold in the first place. I think when we spoke earlier this year, it was really about central banks being the marginal buyer. And of course, they've come out since COVID, they've really upped their purchases. Believe it or not, in Q3 of this year, the demand for gold was the highest it's ever been in recorded history, 1,300 tons. And the big new buyer now was ETFs. So that's institutional buying, that's retail buying. Physical demand is huge. We're seeing lines for gold bullion in places like Costco and things like that. So my point is these are structural kind of generational tailwinds, leading gold higher and higher and higher. But when it rises that quickly, that fast, there's always going to be some technical pause, especially when we see something like interest rate expectations shift like they did yesterday.
So would you see this, Ben, as okay, this is a pause in a broader secular rally? Is that how you'd frame it?
Absolutely. So the question now is, all right, well, does this kind of a consolidation sideways? How does it trade down? If so, to what degree? So we're really looking at technicals here. We're seeing a lot of dip buying, below $4,000 an ounce, which I think is healthy and instructive. I think the big question now is really about the economy. If we see a recession, we could see gold retest, maybe 3,800, 37 down to 36. But again, you're going to see big institutional buying come in there because remember, these central banks, these institutional buyers, these physical buyers, they're buying and holding. For them, it's not a trade. It's a confidence vote on fiat.
In terms of your price ranges, here I want to put this number in front of you. Goldman Sachs, all right, here's what they're telling clients. They say they see gold hitting 4,900 by the end of next year. What do you make of that call?
I think that's very likely.
You do?
We're on that train. We think it's probably hard to see how it doesn't hit that. We'd have to see kind of a huge spike in interest rates or something really structurally change. But again, this is part of the kind of currency debasement trade. And again, when we spoke earlier this year, it was really central banks were selling treasuries, buying gold. For the first time now, central banks actually own more gold than treasuries. But now that trade, so to speak, has kind of shifted into Main Street. And again, that's why we're seeing physical buying. So this is a generational secular trend here.
Well, sticking with central banks, though, you heard from the Fed. Now, they gave you the cut, but then Powell comes out and says, well, that December cut, that's no sure thing. Far from it, I think he said. You watched that and thought, okay, the impact on gold is what there, potentially?
Well, the near-term impact is negative.
Right.
Gold is competing for interest rates. But again, you look at Powell, and I think that the question is, all right, to what degrees does that overwhelm kind of the structural demand shift that we're seeing? And in the near term, I think that is the risk. If we see the economy really start to slow down, that could weigh on gold. Powell, I think if you read between the lines, was kind of really concerned about inflation more than jobs. So that those will be the numbers to keep an eye on. But again, when we look at kind of the demand that's emerging for gold, and even you talk about, I think Goldman Sachs, not just their price target, but they're now starting to recommend higher allocations to gold in 60-40 portfolios. It's not dissimilar to what we saw with Bitcoin, kind of quote unquote going mainstream. Gold is re-emerging as kind of the favored quote unquote alternative holding within 60-40 portfolios.
So we talked central banks. In terms of geopolitics, a lot going on this week. Also, Trump and Xi, you had that meeting, first face-to-face meeting in a long time. To the extent that you see U.S.-China tensions de-escalate, Ben, the impact on gold is what? I mean, does that reduce, safe haven bid?
That probably reduces the safe haven bid a little bit. Now, again, in the context of kind of broader demand, it certainly doesn't do anything to address, the kind of fiscal and monetary deficits. But I do think that reduces the safe haven bid a little bit. I think too, the market has started to discount kind of, U.S. and China just posturing, both kind of looking for a deal. We saw this with, Trump 1.0, where he and Xi Jinping kind of, agreed on terms, shook hands, got the, the Oval Office picture, but then both sides went away and didn't really do anything. So I think the market is starting to kind of discount that rhetoric a little bit. And yeah, could that temper gold a little bit? Absolutely. I think it could potentially elongate the consolidation that we're seeing. But in terms of intermediate and longer term expectations, it's tough to see how gold's not hitting $5,000 an ounce next year.
I want to end on this because we've been talking gold, but I also want your take on silver. Let me make sure I get this right, Ben. You say silver could hit 100 by end of next year. What's driving that view?
So silver's interesting because now that's at the very top end, but silver's interesting because it has a really robust industrial use case. So it's solar, it's the electrification build out. So we've seen, AI has been kind of the dominant theme for the last year. That's spilled over into copper as part of the electrification build out, even things like uranium and nuclear. Silver is now part of that. And if you look at China's version of their big, beautiful bill, a lot of that is solar build out, which is going to need physical silver. And there's a rush on physical silver right now. It's very hard to get. In fact, even in one of our funds, we're expecting to take delivery in the December contract. We're starting to trade physical because there's more paper contracts than physical, and this is similar to what we saw in the 1980s. So the silver is facing its own supply squeeze because of that physical industrial demand. But again, it's now part of this currency debasement trade that is, again, a kind of a multi-year, multi-decade uptrend.
Yeah, look at that chart. Ben, great to see you as always. Thank you, sir.
Thanks, Josh.
Now time for some of today's trending tickers. Going to start here with Roblox, the company topping third quarter estimates for revenue, bookings, and daily active users. Roblox also lifted its full year outlook, beating expectations. Consolidated net losses, however, saw a rise compared to a year earlier. Company also facing looming challenges in 2026, including potential headwinds from tough comps and new safety policies. And Fox Corporation delivering a beat on earnings and revenue for the first quarter. Citi noting strong performance of the company's television segment, advertising revenue also topping the street's expectations. Bloomberg Intelligence highlighting ratings and advertising for live news and sports continues to anchor Fox's outperformance. In addition to quarterly results, Fox also announced a $1.5 billion accelerated share repurchase transaction. And lastly, Kimberly-Clark, the owner of the Huggies and Kleenex brands, delivered an earnings beat for the third quarter. Organic sales rose 2.5%, exceeding analyst estimates of 1.9%. While looking ahead, company expects its 2025 adjusted operating profit to grow at a low single-digit rate on a constant currency basis versus the prior year. Meanwhile, adjusted earnings per share expected to grow at a low to mid single-digit rate. We're wrapping up today's Market Domination, but don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime. That is the closing bell on Wall Street, and now it's Market Domination Overtime. We're giving you full coverage of all the moves, get you up to speed on the action from today's trade. Yahoo Finance's Inez Ferre joining us now with the latest market action. Inez.
Josh, right across the board for all three major averages, the Dow ended the session down 0.2%, or about 110 points. The NASDAQ Composite was down the most, down 1.5%, and then the S&P 500 down about 1%. Taking a look under the hood where we ended up with these stocks, we're looking at the NASDAQ 100, a mixed picture there, as I just mentioned with the NASDAQ. Amazon down more than 3% ahead of its earnings. Also, Meta down 11% after its earnings report yesterday. And then Nvidia today down more than 2%, ending the session below the $5 trillion valuation mark. Apple up 0.6%, and Tesla is down 4%. Looking over on the Dow, again, those big heavyweights that have been under pressure throughout the session today. And over on the sector action, we're looking at consumer discretionary that's down. Tesla is included in that, of course. course. Communication services down more than 1%, and materials also down more than 1.3%. Financials, healthcare, and real estate, those were really the only sectors that were in the green for the session today. And then over on the crypto space, we have been watching Bitcoin rolling over, down 3.8% at just below 107,000 per token. ETH also down more than 5% at around 3,700 per token. The crypto stocks also today in the red, Josh.
All right, thank you, Inez. Well, Amazon third quarter earnings are just now crossing the wire. Let's get you those numbers. Q3 EPS, $1.95. The street was at $1.58, so that's a beat. Net sales, let's look at the top line, $180.17 billion. The street was closer to $177.82 billion, so that is a beat. AWS net sales, we know obviously investors make a beeline for that. That is the cloud computing business. Net sales there, ex-FX, up 20%. Consensus was closer to 17.9%, so that is a beat. Q3 North American net sales, $106.27 billion. The street was at $104.96 billion. Looking ahead here, Q4 operating income, they're looking for between 21 to 26 billion. The street was closer to 23.78 billion. And Q4 net sales, the range is at 206 to 213 billion. The street was at 208.45 billion. At least initially here, we're seeing a strong move in the after hours. Remember, heading into this print, the stock had a nice move over the past 6 months, but it was basically flat year to date. It was up about 2%. But initially here, investors like what they see. Now that you have AWS's numbers, you have a full picture of that cloud computing battle, because you also have, of course, Microsoft and Google. You can throw Oracle in there as well. How's that war shaping up? Who's leading? Who's lagging? We have a smart analyst coming up shortly who's going to walk us through all of that. Well, our next guest says the Fed's latest rate cut may have added fuel to an already speculative market. Should the focus shift away from unnecessary speculation into broad-based growth? Let's welcome in now Rich Bernstein, CEO of Richard Bernstein Advisors. Rich, great to see you, sir, as always. I want to get to the Fed, Rich, but I feel like, listen, Amazon just crossed, at least initially. Investors like what they see, but these big tech earnings, Rich, it's been kind of a mixed bag so far in terms of investor reception. You've been watching these big tech earnings roll in, listening to conference calls. What are some of your big takeaways, Rich? What have you learned?
So, Josh, I think the biggest thing with some of these companies that garner so much attention is not whether their businesses are doing well or not. The question is, are their businesses uniquely performing well? That's the issue. There are a lot of companies in the United States, a lot of companies around the world that are growing as fast, if not faster, and nobody cares. And I think that's the speculative element that people should be thinking about, is the amount of attention focused on this very small group of companies when you have lots of other companies that are growing as fast, if not faster.
Let me ask you, Rich, we were watching these earnings prints for a lot of reasons. One reason, though, we were looking for greater line of sight into that great AI trade and trend. And Rich, this has been a question that's been out there. It's been asked. Smart people have different opinions. AI boom or AI bubble. I'm sure your clients might be asking, Rich, what are you telling them?
So what we're telling them, Josh, is that we have to separate the economic story from the investment story. And I think people have a very tough time separating those two out. The economic story is, will AI change the economy? And the answer to that is, of course it will. I mean, why would anybody argue otherwise? But let's remember that technology always changes the economy. The internet changed the economy, right? The automobile changed the economy. My personal favorite, the light bulb, changed the economy. A massive productivity enhancing technology at the time, because it turned the economy to a 24-hour economy, right? Kind of a graveyard shift in the dark. We don't even consider it technology anymore, but it was a massive productivity enhancing technology at the time. So will AI change the economy? Of course it will, but that's always true that technology changes the economy. The investment story, though, is one of how much capital is chasing AI, and long-term investment themes, the success of long-term investment themes are always based on the supply and demand of capital. You want to think like the one banker in a town with 1,000 borrowers. So the question we should all be asking is AI starved for capital? I think everybody would say there's no way that AI is starved for capital. So I think it's going to turn out that overcapitalization of the story makes it spread through the economy very rapidly, maybe more rapidly than it otherwise would have, but it also hurts the long-term investment story.
Let me ask you, Rich, I want to get your thoughts on the Fed as well. Another big theme this week. You heard the Fed. Now, the markets get the cut they were expecting. But then, of course, Jay Powell at the presser, he makes headlines because he's looking ahead. He looks at the December cut. He says, listen, far from it, I believe, right? Lots of questions there. What did you make of that?
So I think a little bit of that is traditional Fed jawboning, right? The Fed doesn't want to get investors and get the economy and get the markets out over their skis prematurely when he's legitimately not too sure of what the future is going to hold. And I don't think anybody can be pretty sure about the future is going to hold here. I mean, uncertainty is almost at record levels. So I think he's trying to jawbone a little bit and try to calm people down. I think some of this might have been, buy on the rumor, sell on the fact type thing. And now the Fed has cut rates, and the market is acting a little more conservatively.
Does the economy and labor market, Rich, does it require cuts?
I would argue no. Right now, my personal opinion whether the Fed should cut rates is pretty immaterial because Jay Powell isn't exactly calling me up and asking me. But I think, look, as an investor, I think there's a couple of things you want to look at. One, GDP is tracking right now at 3.5% to 4%. That's real GDP tracking 3.5% to 4%. We've got inflation still running at 3%, and in some measures going up. So we're not even heading towards the Fed's 2% target. So, you think about that. Employment is weakening, but it's not weak, right? And certainly the inflation front is not subsiding. So I would argue the Fed really doesn't have to. More important than anything else, Josh, is I think people have to remember that the Fed does not directly impact the economy. The Fed alters the economy via the banking system. So if the banking system is seizing up or there is some hindrance to lending that is slowing the economy, it makes perfect sense for the Fed to cut rates to try to make the cost of funding for banks cheaper, which hopefully will get them to lend more and therefore stimulate the economy. So the question we should all be asking is, where in the financial sector is the hiccup that is hindering lending, that is stymieing growth? The answer to that is it's nowhere. It just doesn't exist right now.
Finally, Rich, quickly, listen, viewers want to know where's the opportunity. I believe you say here, Rich, in the notes, go where they ain't. Well, where ain't they, Rich? Explain that.
They ain't. Where ain't they? Well, the number one I would say that they ain't right now, Josh, is in high quality non-U.S. companies. These companies have a projected earnings growth rate that is faster than that of the Mag 7. Their dividend yield is 10 times that of the Mag 7, and they sell for 30 to 50% lower valuations.
Rich, we are always lucky to have you. Thank you, sir.
Thanks, Josh. Great seeing you.
Amazon reporting third quarter earnings moments ago. For more, let's bring in Yahoo Finance tech editor Dan Howley. Dan, what do you think?
Yeah, Josh, obviously a big beat here on both the top and bottom line. I think one of the main things to talk about is how well they performed on the cloud. Andy Jassy saying that jumped 20% year over year, AWS re-accelerating on that part. And then obviously that helps put to bed temporarily put to bed some of the fears that they weren't performing well as far as the cloud goes. They also say that their Trainium business, that's the chips that they use, now is a $1 billion a year business. And they said they've launched or started to launch their giant Rainier kind of data center that uses their Trainium chips with 500,000 GPUs. That's going online now. So a good quarter for them on the AWS side. Obviously, investors reacting. The shares were up more than 9% last time I checked.
Thank you, Dan. We'll be right back. Stick with us. Amazon reporting third quarter earnings just moments ago. For more, let's bring in Yahoo Finance tech editor Dan Howley. Dan.
Yeah, Josh, that's right. The company beat on the top and bottom line, surprising to the upside on AWS. Andy Jassy saying that it's re-accelerating when it comes to growth, growing 20% year over year. So that's a big win for AWS. He also says that their Trainium chip business, which is their custom chips that companies use to train their AI, is now a multi-billion-dollar business on its own. He also said that they launched their Project Rainier, which is their gigantic supercluster of 500,000 Trainium 2 chips. So that's going to be used for things like training their own AI, training Anthropic's AI, and deploying those models across AWS. So obviously that was the big kind of bugaboo when it came to reporting Amazon's earnings. They also saw obviously strong results from their retail sector, but investors were mostly interested in this. Still, Amazon's lagging Google and Microsoft, its cloud rivals, when it comes to the stock price year to date and over the last 12 months. But this will give a boost to the company. It's up about 9% now.
Dan, thank you. Well, Amazon reporting, and now I want to get more reaction to this with Scott Devitt, Managing Director of Equity Research at Wedbush Securities. Scott, great to see you. So Amazon reports this stock, it is soaring here in the after hours. AWS revenue, Scott, jumps 20%. That was better than expected. But give us your take on this report. What do you make of the results?
Some time. It's some painful lately. Amazon has three businesses: the retail business, the advertising business, the AWS business. It's become a more complicated company over the years, and if all three businesses aren't kind of clicking at the same time, it's led the stock to underperform. And frankly, the AWS business relative to peers, as this AI boom has begun, has underperformed. That's now starting to change. So overall,
All right, I think we lost Scott there for a second. We'll try to reconnect. Time now for To Watch Friday, October 31st. Going to start off on the earnings front here. We'll be getting some key reports from the energy sector on Friday. That's going to include Exxon, Mobil, Chevron, and Dominion. Exxon announced results for the third quarter in the morning. Analysts expecting the company's Q3 results to get a boost from its downstream businesses, which could add about $1.1 billion to profits, but lower oil prices might hurt earnings by about $700 million. Moving over to the Federal Reserve, some more commentaries coming on Friday from Fed Presidents Lori Logan, Beth Hammack, and Raphael Bostic. This coming after the Fed cut interest rates by 25 basis points on Wednesday. Fed Chair Jerome Powell saying in the press conference that there are strongly differing views about how to proceed and that another cut in December is far from a foregone conclusion. And taking a look over at the media space too, Disney and YouTube TV, they are facing off in a high-stakes dispute that could pull ABC and ESPN off the Google-owned platform if a new deal isn't reached by midnight. YouTube TV, now topping at 10 million subscribers, is pushing for shorter, cheaper contracts as it gains leverage over traditional media giants like Disney. Apple's chief turns 65 in a few days on November 1st. If he chooses to retire, Apple has big shoes to fill, of course. Take a look at a few potential candidates that may be under consideration.
Good morning. Welcome to Apple Park.
Apple may not be the powerhouse it's become without CEO Tim Cook. He served in the position since 2011 and has overseen the rollout of some of Apple's biggest products, including the iPhone X, the launch of its TV streaming platform, Apple TV Plus, and ushered in Apple's push into financial products with the Apple Card. Now the company faces pressure from Wall Street over its slow move into AI and the search for its next big product post-iPhone. This has led analysts at Lightshed Partners to question whether it's time for Cook to step aside and make way for a product-focused CEO. Right now, there's no indication Cook is in danger of losing his job, but Cook is 64 years old, and despite his successes, he won't lead the company forever.
Cook continues to be the Hall of Fame CEO. He will lead Apple, I believe, at least the next 5 years.
It wasn't that long ago that you could give Tim Cook credit as having created more value as a CEO than any other CEO in history. And we're talking about like 2 to 3 years ago. It's not that long ago.
I think there's a sense that, maybe some fresh blood in terms of the thinking within executive management would make some sense.
That leaves the question of who will take up the reins of one of the most important technology companies in the world. Jeff Williams, Apple's previous COO, was once seen as Cook's potential successor, but he's retiring from the company later this year. Still, there's no shortage of top candidates at Apple who could take over for Cook. Craig Federighi, the company's senior vice president of software engineering, leads development of its Mac and iOS products. He also makes regular appearances at Apple's Worldwide Developers Conference, making him one of the most visible candidates in Apple's lineup. John Ternus is also a solid option as Apple's future CEO. He's been with the company since 2001 and has overseen the development of a number of products, including the iPad and AirPods. Perhaps more importantly, he's also been instrumental in Apple's move away from using Intel chips in its Macs to its own processors. Greg Joswiak, Apple's senior vice president of worldwide marketing, has worked at Apple since the late 1980s, giving him a wealth of knowledge about the company and its various products and services. Eddie Q, Apple's senior vice president of services, currently leads the company's most important business segment outside of the iPhone. He's been with Apple since 1989 and brings the institutional knowledge necessary to navigate such a massive company. And then there's Deirdre O'Brien, Apple's senior vice president of people and retail. A 30-plus-year Apple veteran, O'Brien brings along the experience and understanding of Apple's customer base that the company needs to ensure it's meeting user expectations. Cook's still on top for the foreseeable future, but it remains to be seen what Apple's leadership could look like down the road.
All right, Dan Howley, we got the Amazon earnings, of course, Apple earnings on deck next. Heading into this print, Dan, the news flow has been kind of positive. Analysts have been doing their checks. They look at, these lead times for iPhones. Some of them saying, listen, they kind of look extended still. They take that as a bullish sign for this iPhone 17 cycle. But with that print on deck, what are you looking for, Dan?
Yeah, real quick, I just want to shout out that guy who was doing that report earlier. Really handsome, really articulate.
Incredible beard, too.
Amazing,
really.
amazing. For the quarter, I think everyone's obviously going to be looking, as they always do, at iPhone sales. But in this particular quarter, it's going to be especially important with the iPhone 17. Now, we had some changes to the entry-level iPhone. It's more of a better value, I think, than prior generations. We also had some physical changes to the Pros and Pro Max. They have better telephoto capabilities on the camera. And then obviously we have the iPhone Air, which replaced the iPhone Plus. Now, there's been, some kind of murmurs that the Air isn't exactly selling as well as people had hoped initially, but the base iPhone is apparently selling well, and so were the Pros. We had seen Counterpoint Research release a report saying that iPhone 17 sales are 14% higher year over year in the US and China. That was in the first 10 days of availability, though. And we've seen Jefferies Edison Lee say that lead times, which is basically from the time that you order an iPhone to the time it gets to you, have been shrinking. Now, what that means is if you have a longer lead time, that means there's more demand. Apple's trying to fill that. Naturally, if more people are trying to buy iPhones at the same time, it's going to take a little longer to get to you. So that shrinking lead time could mean that we're seeing a collapse or at least shrinking in demand from the initial jumps that we had seen when the iPhones were launched. Outside of the iPhone, obviously, services is the second biggest business that Apple has, continues to grow. We're expecting to see, as far as revenue goes, we're hoping to see got to pull it up here, $28.2 billion in revenue for services. That would be an increase of 12% year over year. And services obviously include, you could think Apple TV Plus, Apple Music Plus, Fitness Plus, as well as Apple Care, things along those lines. Wearables, that's expected to actually decline year over year, about 4.5%. So we're also supposed to see Mac and iPad revenue grow, but only slightly. We saw those new iPads and Macs come, but those just came out. They're not going to hit for prior quarter.
Dan, thank you as always. Appreciate the analysis. Well, that is going to do it for today's Market Domination Overtime. Be sure to come back, though, tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. But don't go anywhere. On the other side of the break, it's Asking for a Trend, and I've got you covered for the next half hour with the latest and greatest market-moving stories. Stay tuned.